Hello and welcome to another weekly update and review session. Today is Sunday, April the 14th, and we're going to take a look at our performance over the last week, talk about some changes in the account, some trades and things like that. But to start off, let's take a look at the last week. And as you can see right here, we are down minus 1.3%. Market is down a little bit more, minus 1.44. So that's nice to see, and hopefully we'll be catching up. We had a little bit of underperformance here, mostly due to extra trades we put on to finance some short-term hedges. But I've since scaled back on the 14-day hedge, and therefore there will be less to finance, because the financing of those hedges increases this medium risk, not the one at the Black Swan event, but the one when the market is pulling back down, we have more trades that are showing a little bit of negative performance. But I'll show you that in the platform as well. But I think we'll be now slowly reversing. Obviously, we have some development over the weekends with Iran attacking Israel. So we'll see if there is any reaction in the markets. But for right now, we're in a pretty good shape. And I'll show you here in the account, we have two negative delta trades. One is the hedge on demand. And as per the plan, I'm putting these on around 0.35, and I'll show you right here just in the trade. And the trading plan has been updated, so there's some some small changes and tweaks, and so make sure you take a look and see, because I'm addressing a few things. One of them is the negative delta trades that we put on. If the portfolio reaches a certain delta, for me it's 35, but it could be lower if your overall CAGR target is lower. You might want to react faster, and just depends on how much volatility you're willing to take. So around 35% for now. We'll test that and see what happens. Basically, if the portfolio delta reaches 0.35 of the net lick, we might implement one of the two negative delta trades and then see how it goes. If it goes further down and we reach 0.35 again, we slap on another one. And as the market is going down, we're just adding those trades, and the early ones will at that point show some profit, and that we can potentially lock in case the market reverses, or leave it on for further protection to the downside. And right now I put one of each. The zebra probably would be better in a low VIX environment, but once we're already in an elevated VIX environment, a hedge on demand would probably work better. And hedge on demand, I have video on that, and most of you are familiar with that. I'll show you in the platform. And the zebra one is just simply a ratio, a zero extrinsic value ratio, where you sell a 50 delta or at the money put, and then buy two puts around 70 delta, to where you pretty much balance out the extrinsic value, and you end up with a pretty static negative delta to the downside. So with the MES, it's going to be a little bit less than around 44 SPY deltas. With the ES would be around 450 maybe, or something like that. And then there's a limited loss to the upside, but we would get out if it starts showing losses. That means the market is reversing, and we would be removing them for a loss. And let me see what else we have. Let me just show you those here. So the hedge on demand, I only put it on Friday, brings in around 17, 18 negative deltas, and it's showing a little bit of a loss at the moment. And then I also put a day before that, or 2 days before that, I put the zebra on right here, and that one is showing a little bit of a profit and giving us around 44, 45 negative deltas. So our deltas right now are 150, but if you add another 40 something here, 17 there, so plus 60, so we would be around 250, and that would bring us back to 30.38 or something. But right now we are at 190 over, let's see, 65 roughly, so 29. So we're right at around 0.29 delta. So that's on that. Also, while we're here, we can take a look at our naked puts and just see if there is anything in danger. These are the older ones. They've been open for a little bit of time, and as you can see, profit and loss since open. This one is in the green, slight negative, and that's it. This is a put debit spread, and then on the a little bit newer ones, we have 58 here. So these are showing a little bit of a loss, 30%, 50, and the worst one is at 65. Obviously, this for right now is nowhere near the 200% stop loss, but it's something to keep an eye on. And hopefully, if the market continues to go down, we'll offset some of those losses with our negative delta trades and the put debit spreads that we have in place. So all in all, everything seems all right, and we'll see how the market reacts next week. But there was something else. Let me see. I wanted to. So we have this, yeah, hedging. I wanted to talk about that. So over the last few weeks, I've been testing a yearly hedge allocation pretty high. It was 10% at some point, and I was buying the 14 DT hedges with that budget. But the problem is that increased my yearly target premium, in order to finance those. And I realized that that's just too much, because having so many naked puts to finance that, in addition to our regular trades, we're making our book wipe loss much larger than we are used to, and that one can get triggered even if those hedges that we put on don't get triggered, because they're very low delta. They would only get triggered in an extreme case, while our naked puts and stop losses can get triggered, in a medium pullback. So we're facing larger, if you think like a medium risk in between, before we go to a 20% drawdown or something, we are facing this more immediate risk, which is increased with this. So I didn't like that trade-off. So I'm testing different things. For right now, I am lowering the yearly hedge allocation and maybe just doing a little bit of harvesting, put debit spreads harvesting with a little bit of funds. But also one thing I want to kind of point out is that these two should work together. The CAGR and the yearly hedge allocation should not be independent. In other words, we don't want to just increase yearly hedge allocation because we want more hedges. We should also be lowering the target CAGR in order to keep the overall, and that's explained now in the trade plan precisely, in order to keep this book wipe loss at an acceptable level, we need to combine these two. So if you're normally targeting 20% CAGR and you want to add a little bit of hedge, then it would be prudent to lower the CAGR a little bit, so that overall we're still around 20%. If you're targeting less, if you're targeting 15 or something, then you would lower it from there. But anyhow, we just don't want to end up in a case where we're chasing our tail. We increasing the hedge and then increasing the CAGR, because all the metrics are now looking better. Although we don't do it, we do it per schedule, but still we would end up just blowing up our risk in the middle here for the book wipe loss. So anyhow, that's on that. And then early trade, yes or no, I did some changes on that. I'm removing the notional exposure, but until I figure out exactly how to measure that, because having some hedges on messes up this figure. So might make you put an early trade prematurely. So I need to work on the formula here. But for right now, if you take a look at the trading plan, where is the accelerated schedule, we're gonna first make sure that we don't have any temporary emergency hedges open. And by that, I mean any of these two. If we have any of these open, that means we are fighting the delta, the positive delta. We don't want to be adding to it. So no, automatic no for an early trade. But if that's the case, that we don't have any of those, and our buying power usage is less than 2x wicks, or and portfolio delta is under 0.2, which means we're in a really good shape, then we could add an early trade on. But keep in mind that also you can change these parameters for yourself in case you're targeting different CAGR and are more comfortable with lower numbers here or things like that. But nonetheless, it's still an option. And yeah, just make sure you take a look at the updated trading plan, because there are a few changes in there. And with that, I will probably be looking again probably on Tuesday. We'll see how the portfolio looks after Monday's trading day, to see where we're at and see what we can do to continue with our campaign. Right, that would be all. Have a fantastic rest of the weekend, and I'll see you all next week. Bye.